So today we need to discuss the metaverse stocks and specifically the mistakes that everyone seems to be making, how you can avoid them and how you can profit from this opportunity. Over the last month I've had a bunch of messages from investors asking me what my plays are, what my thoughts are and what my strategy is for this megatrend. On Investing YouTube it seems that everyone is talking about the metaverse and the various ways of playing this from an investing perspective that's guaranteed to make you at least 10 times your investment from here. Now, I'm not wanting to ruin the party here, but on a risk-adjusted basis, from all of the stocks I've seen mentioned, my personal view is that that is highly unlikely. In this video, we'll run through a handful of the most commonly mentioned ones and discuss why I think this is the case and what the most likely pitfalls are in each case. As is always the case with many of these trends, the initial excitement and euphoria leads to a run-up in valuation for the smaller cap ones, which in turn exacerbates that same excitement and investors race to get a piece of the action. It often doesn't take long, as we've already seen a bit of this here, where this falls back and those who rushed without taking their time to do their due diligence end up sitting on paper loss at a very early stage of their investment. Of course, anyone investing in metaverse plays should be aware that these are long-term positions. It's not something which will happen overnight, and you have to have the right mindset that goes along with such investing in enduring the ups and downs, being aware that it is never a clear linear journey. Now before we get into it, please smash the like button, subscribe to the channel if you're new and check out the Patreon for the private Discord. Most importantly, whilst my full-time office-based job is investing related, I'm not a financial advisor and this video is purely for educational and entertainment purposes only, but let's get straight into it. So what are my views on this metaverse trend specifically? So firstly, I think it's important to touch on this a bit to provide some context. I do personally think it's hard to argue with the huge potential from the metaverse and the opportunities for a new stage of digital consumption and participation for consumers. Clearly, Facebook's rebranding to Meta Platforms was a big signal of this potential, and there's a load of other big tech focus on this sector and making this mega trend happen. But ultimately, it feels like it is at such an early stage that it's nearly impossible to accurately predict what this will end up looking like. It's almost the equivalent of Elon Musk prior to the funding of Tesla saying that he wanted to produce electric cars. It would have been impossible to predict with a good degree of certainty how this would work, who the key suppliers would be, and what the main technologies powering this would be. And so that is the closest analogy that I can quickly draw to compare to where we are currently now in the metaverse megatrend. Now, personally, one of the craziest things I've seen and just cannot get my head around yet, and please shout and let me know why I'm wrong in this logic and why I'm thinking about this incorrectly, is the purchasing of digital land on the metaverse. For me, this kind of feels like almost back in the day buying space on Facebook's website and hoping that it would increase in value, it would become a scarce asset and supply would not increase, and the appropriate liquidity existed to then sell digital space and making a profit from it. I'm showing my age here a little bit, but it's almost like that web page in early 2000 which comprised of 1 million pixels and each pixel was sold for $1. It had a load of hype at the time, people thought it was really cool, but needless to say, it died down and did not amount to anything more than a marketing gimmick really. That's almost exactly what buying digital land feels like to me at this point in time. Look, maybe I'm wrong and maybe people make massive returns from this, but at the moment it feels to be far too speculative and is basically gambling rather than investing. There are so many different platforms also offering this same opportunity and not all of them will succeed, if indeed any do at all, so that's the first challenge there I see. I see a load of these celebrity endorsements for different platforms too. And I hate to say this, but they're being paid to be involved in this. They do not care whether this project actually works or not. To get a better feel for it, I try and compare this to the development of the internet. When it first started becoming mainstream with household access, we all knew the internet was going to be the future, but nobody knew exactly how this would play out and how important that would be in everyday life. One just has to look back at the dot-com bubble with everything running up in valuations. We know how that played out, but if you look back at it today in specific companies, many of them are no longer with us. Even more recently than that, in the social media war and the battle for becoming the dominant player here, before Facebook, many of us spent many hours sunk into the likes of MySpace, Bebo, Pixo, curating a social media page, but ultimately the result of that was that none of the first movers won. Facebook did. And the same could very much happen within the metaverse, so Sandbox and Decentraland are not guarantees to financial freedom, as I see them touted by so many financial influencers at the moment. You could very well find yourself holding onto worthless blocks of digital wasteland. Now before we go into the specific stocks too, I think it's important to remember how adoption works. Full market penetration and acceptance will take many years, and as investors your time horizon needs to match that. Now think back to smartphones. Whilst a small percentage bought the first generation smartphones, it wasn't for many years after that when the infrastructure in terms of faster connectivity improved that they became mass adopted and that the manufacturers recognised significant revenues and profits from them. It took many generations of iPhone for that to be a meaningful impact on Apple's valuation, for example. So anyway, moving on. What are the key ways to play this trend, and what do I need to avoid? So the first name to talk about here is Facebook, or as it's now known, Meta Platforms. Clearly this is a good place to start. They have a monopoly over social media and seem to be the main flag bearers from a big tech perspective on this trend. I think it's fairly likely they will play a role in the future here, but the important thing to remember for now, for investors in this trend, is that it currently comprises of zero revenues for the business. Now hold up, before you start screaming at me about Oculus, we will come back to that. For Meta Platforms at the moment, the Metaverse is not yet a properly monetized opportunity for them. It is a prototype which they're working on and refining, and it is not at a commercially viable stage at a mass level yet, nor is it at any recognisable stage of adoption yet. So now back to the Oculus point, the VR headset platform which Meta acquired a few years back. This is a few generations in, and clearly there is a logical route of access to the Metaverse through this. It's not guaranteed, but I think it's got a fairly good shot. All that being said though, Oculus accounts for less than 1% of Facebook's global revenues. Hardware margins are typically much lower than those of software, and so on an EBITDA and the contribution to cash flow basis, this is much less than 1%. The result of this is even with significant growth in Oculus's global adoption, it's a long way from moving the needle on Facebook or Meta Platforms valuation, and so the Metaverse play on Facebook is not going to be one that's going to be making you 3x your investment anytime soon. The other thing to remember is that given Meta is a much more diversified company, it's going to be impacted by many more dynamics and challenges totally unrelated to the Metaverse. The potential regulation on Facebook is just one of those clearly, which is a massive cloud hanging over the company. Now clearly, NVDA is another stock we need to talk about, and it's one that many others see as similar in nature to Meta Platforms in that it's a good, solid play for the Metaverse and more of a pick and shovel solution rather than necessarily trying to back the right horse. Now this is something personally which I could get behind a bit more, and I do think that's a more backable thesis. But again, it has the same dynamics at play that Meta does. Currently, the business provides critical hardware for a number of computing applications. Until we see significant growth in the Metaverse and greater adoption, the growth from Metaverse-related revenues won't move the needle on NVIDIA's stock valuation in the slightest. As with hardware companies, one always has to worry about the tech and product risk. The potential that a competitor may develop something superior. Clearly, over the last 2 years or so, the silicon shortage has resulted in lower levels of new product development among some of the largest players. This has provided a window of opportunity for new competitors to develop new competing products. It also seems that this silicon shortage is likely to be with us until at least mid-2022. So when dealing with the tech-related hardware, it's so important that the cycle of creative destruction, and by that I mean continually innovating and improving your most previous iteration of a product, to ensure that competitors are unable to keep up. It's why you see smartphone annual renewal cycles, for example, and it's a great way of ensuring you remain ahead of your competition. Clearly, this has massive capex and investment demands, but we'll come back to that shortly. For a large cash-generative business like NVIDIA, this is clearly not an issue, but the challenge here is more related to smaller hardware businesses looking to enter the market and gain market share. So, having said that, let's talk about some of these smaller players, where the whole strategy is focused solely around the Metaverse, and where monetizing and successfully capturing the opportunity could lead to multiples of the initial capital invested as a return. Now these are companies which today are very small and are all in on that Metaverse megatrend. Personally, I think there are 3 main pitfalls or concerns thinking about stocks in this category. Now we'll run over these and then review specific stocks I've seen touted a lot. The first of these is the dilution risk. Given that many of these companies are loss-making and some of them are even pre-revenue of anything at all, you need to consider that. When a company is making a loss, it has to fund these losses somehow. Once the cash on the balance sheet is gone, the company will have to raise equity. So differently, it will sell some of its own shares to new investors in order to raise money and pay those expenses. For existing investors, unless they also buy some of these shares in a ratio equal to their own shareholding, the percentage of the company which they own will decrease. To put this into an example, say a company has 1,000 shares and I own 100 or 10% of the company. If the company issues 100 more shares and sells these, unless I buy 10 of those shares being sold, my ownership percentage will decrease to 9%. Add to this dynamic the prospect that many of these companies are likely to be loss-making for a substantial period of time. Investors in these companies should be very much prepared for this dilution dynamic to play out over a long period of time and for this to be an ongoing challenge which these companies face. Now the other important dynamic here to remember is that as stock prices fall, the company then needs to sell a larger number of shares than it would do when the stock price was higher in order to raise that same amount of money. Now the next pitfall is actually the reality of these companies getting traction and capitalising on the market opportunity. We've covered this somewhat before, but the risk is more acute with the smaller, solely dedicated to the Metaverse players. A quick example could be, say, a manufacturer of haptic components. Think of this like the touch feedback element of the hardware. Whilst they may be a supplier of a good component, there is a risk that a competitor that may not even be listed on the stock market becomes the provider of that haptic solution, which is selected by the ultimately market-winning overall hardware solution for accessing the metaverse. Ultimately, in that situation, the company would never deliver on its potential. This would ultimately result in the company failing to deliver on its potential, and a lot of that potential is clearly currently priced into the stock price. Now, the other component to this, which gets overlooked far too often, is say that the company is successful and its strategy does become the main supplier to the leading hardware solution for metaverse access. The company then faces a massive concentration risk. With such customer concentration comes limited ability to increase margins, and all of this ultimately clearly feeds through to valuation potential too. Now, the third and by no means only remaining risk, but one which we're discussing here, is the capex requirement. In more simple terms, the cash which is required by the company in developing and manufacturing its product. This impacts cash, and while it doesn't hit the P&L or income statement, it does hit cash, which again is something which investors need to be acutely aware of and understand how the company is going to fund this. So with that said, let's dive into the most commonly mentioned smaller players and see what the main challenges here may be. First up, let's talk about Immersion Corporation, ticker symbol IMMR. This company produces haptic feedback technology and is in fact the provider of the haptic feedback technology which is currently in the PS5 controllers. Now, don't get me wrong, it is good the company does currently have a working solution, but the result of this has been very lumpy revenues. For the continued research and development, the company will need to increase its investment, and so that has an increase in the capital expenditure which will be required and will increase the cash burn rate within the company. Now, for the financial year to December 2020, there was a 27 million decrease in its cash balance. Assuming this rate increases as they invest further, the cash on the balance sheet at December 2020 of just shy of $60 million won't last forever, and so I'd not be surprised to see the company dilute shareholders at some point and raise more equity. Indeed, during 2021, the company did enter into a $50 million agreement to raise equity, and while some of this has happened during the year, there's definitely more to come. I don't think this will be the final time it happens, so investors in this company need to be acutely aware of that, especially as it may take some time for the company to get out of this situation, especially if they are reliant on the metaverse opportunity. Also for me here, there's a massive tech risk too. Maybe the final hardware solution that wins the race of being the market leader for the hardware access in the metaverse does not use the IMMR solution, which would clearly have an impact on the company's valuation and the company's potential. Now, the next up to talk about is Alpha Esports Tech, trading on the OTC as ticker APETF. Now, the first health warning here is that this is a very small company and is fairly illiquid, which in itself is a risk that investors should consider. It provides esports solutions with a renewed focus on the metaverse, having established many partnerships with real-world sports brands and businesses. It's currently generating negligible revenues and has some pretty material costs, so this is one where more shares will almost certainly be issued in order to raise money from investors to fund those losses. There's also clearly the risk that it fails to materialise into anything that enables the company to generate revenues at all. Now, the next one to talk about is Metamaterials, ticker MMAT. Now, this company develops specific materials and nanocomposites focused on the visual elements of the metaverse. Very similarly to Alpha Esports, it's burning cash, generating negligible revenues, and again will likely dilute shareholders in order to keep the lights on within the business. It also faces the same tech risks and requirement to increase its investment in order to continue researching and developing and prototyping various new solutions. So investors should expect the cash burn rate to increase as well, or if it doesn't, the company isn't really doing its job properly. Now, the final one for today's video, but by no means the final one at all, there's loads of other stocks, but this is just a few that I've cherry picked, is Blue Hat Interactive Entertainment, ticker BHAT. Now, Blue Hat is a China-based business and produces augmented reality games and related technology and interactive solutions. While the company has demonstrated consistent revenue growth, it's not burning cash at the same rate currently. Whilst the company has generated consistent revenue growth, it's not burning cash at the same rate currently, it does face the same tech and product risk here. Its valuation is fairly rich, and there is an expectation amongst investors that the company will develop a strong metaverse proposition. Any failure to do so will likely impact stock prices somewhat. Now, clearly this list is not exhaustive, but try and ascertain the company's positioning in light of these risks in order to be able to get a better feel for how that company is positioned. Of course, if you do have a specific one you want me to take a look at, please let me know in the comment section. I'd love to do that. But in summary, pure play metaverse opportunities seem like a very high risk strategy with what feels like a low risk weighted reward profile. So for now, I'm staying away. I think there will be plenty of opportunities to capitalise on this trend over the coming years, which when we as investors will have a greater degree of visibility on the market and how it's likely to evolve and play out. I think it's not until this point in time which we will see much more active professional investor and institutional capital involvement, which was what will really begin moving the needle on valuations too. I think that, and a lot of focus on investor excitement, predominantly amongst retail investors, has resulted in some pretty full and punchy valuations for some of the pure play players, and so I see a significant degree of execution risk here, which does not align to my own personal investment strategy and portfolio goals. Yes, while a couple of these may deliver on their strategy, I would be highly surprised if they all did, and so investors should act with caution here. Anyway, thanks for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel, make sure you're subscribed. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.